Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. Let us take a look at the stories for the day. India's largest household goods maker, HUL, believes that rural slowdown is finally bottoming out. But the largest car maker of the country, Maruti Suzuki, has sounded a note of caution, saying it has witnessed a decline in bookings in April. The reason? Elevated inflation and weakening consumer sentiments in rural areas due to uncertainty around monsoon. So, as the companies with rural presence are coming out with results for last quarter of FY23, what do they suggest about rural demand? Is it finally reviving? And what do they tell us about the state of our economy? Debarghya Sanyal does a reality check. Close to 70% of the population of India still lives in its villages, and it contributes about 35% of the total FMCG sales. So, for all fast-moving consumer goods or FMCG firms, a lot hinges on the purchasing power of the people living there. While urban parts of the country seem to have recovered from the pandemic shock, the rural areas are still limping back to normalcy. And it reflects in the quarterly results of companies which have a base in villages. FMCG major Hindustan Unilever (HUL) recently reported 9.66% on-year jump in its March quarter profit and 10.9% rise in its quarterly revenue, missing the industry estimates. Later, its Chief Financial Officer Ritesh Tiwari said that the FMCG market growth showed gradual improvement, with rural slowdown bottoming out. Total FMCG market volumes, which were declining earlier, have now become flat. While rural volumes continued to decline, the extent of decline further reduced in this quarter. He added that for the full year, volumes in rural areas fell 7% and it declined 3% in the quarter, indicating a gradual recovery. A declining rural demand has been a persistent concern for FMCG firms for nearly 2 fiscals in a row. According to a February Nielsen report, rural consumption had earlier declined for 6th consecutive quarters at the end of Q3 for FY23, with a growth rate of negative 2.8%. In terms of the value growth for the entire year, HUL said its rural growth was only 4%. Over the last year, consumer spending has been impacted primarily because of inflation. Consumers in rural India have felt this pressure the most, and rural markets see continuous negative consumption growth. FMCG firms with a strong rural presence such as Dabur, Marico and Godrej Consumer Goods, while still waiting to declare their Q4 results, have all cautioned against slowing or declining rural demand in their pre-results update. Dabur has cautioned rural demand is likely to remain muted, while Marico seems optimistic. It does mention that a healthy monsoon season will be critical. This cautionary stance regarding rural demand and dependence on the monsoon is in fact prevalent across sectors. Maruti Suzuki, which saw a 42% jump in its Q4 profits, is also keeping a keen eye on rural demand. In a recent statement, the auto major said unseasonal rains and the expected irregular monsoon due to El Nino could have an impact on rural sentiment, and an impact on rural demand can adversely impact the overall demand pattern for the automobile industry as well. For the auto industry, 30% of the sales are in rural areas.
Last sort of 5 to 6 quarters, rural demand has been slow, but there is a sense that the demand is now, that the slowdown in rural is sort of bottoming out, as some of the results of some of the large FMCG companies are also starting to show that the demand is starting to, if not revive, at least the decline has stopped.
So, will a decline in rural demand be felt across sectors in Q4 as well? If so, what are the major reasons?
For two reasons. One is that the very high rate of inflation. So, effectively, if you look at both the growth of rural wages as also the urban wages, both of them have been actually negative. So they simply start cutting on their consumption. This may not be so true of the urban areas where largely the incomes are protected, but that cannot be said about the rural population or a large section of the population who either earns their living on a daily, quarterly, monthly wages, or their income is linked to the crop cycles.
And how will this impact the larger economy? And in case rural demand continues to decline, will the government have to intervene?
If rural slows down, the overall economy slows down. Now, with the rural sort of starting to revive, or at least the decline slowing down, it means that consumption is again starting to grow in rural. Not so much subsidies. So agriculture is very critical. So having monsoons, having the right sort of technologies to help farmers, giving them access to markets so that they can sell their product, and also to be able to support the farmers on the pricing for commodities, especially on food products, is very, very critical. So also we are starting to see global headwinds, whether it's inflation, whether it's commodity prices, whether it is the supply chain bottlenecks. All of these are starting to ease a bit. So I think that will also help in terms of the overall sentiment, and also sort of especially interest rates. As interest rates start to stabilize and eventually come down, that will also have give more money in the hands of consumers for them to be able to spend.
Their key focus would be to somehow protect the kharif crop. The other bit government can do is that in these kind of situations, certainly government can encourage the farmers to go for a better mix of crops. And the third thing which government can do is, of course, support them through certain fiscal measures, through MNREGA program, or for that matter, transferring of some money into the accounts of the farmers, and so on and so forth.
Experts believe, therefore, that even as monsoons will play a crucial role in determining the course of rural demand in the coming quarters, it will take some time to cross over from a negative to positive growth rate. However, if the monsoons are not favourable, the government will have to intervene to offer some cushion. The government's intervention, meanwhile, to give a fillip to electric vehicle manufacturing in the country seems to have hit a roadblock. It recently slapped fine and deregistered two key players, Hero Electric and Okinawa Autotech, from its ambitious subsidy scheme to promote electric vehicles. The two companies were accused of misappropriating subsidies under the FAME2 scheme. Ola Electric too was found involved, but it has accepted the violation and will reimburse the subsidy. So what went wrong with the FAME scheme? Tariq Ahmed's report brings the answer.
Vehicles with green number plates are increasingly turning heads at traffic signals. They are evoking curiosity as people often inquire about the cost and mileage from the owners. The government too wants the shift to fulfill its green pledge. By 2030, it wants to electrify 80% of two-wheelers and 30% of private cars. And for that, it has to make them affordable. So in 2015, it rolled out an ambitious subsidy scheme. It was called the Faster Adoption and Manufacturing of Electric Vehicles, or FAME scheme. The plan was to subsidize production costs for EV makers so that they sell affordable vehicles. Its second phase kick-started in 2019. With a total outlay of 10,000 crore rupees, the second phase of FAME scheme was initially planned for 3 years. But now, it has been extended till 31st March 2024. Under FAME 2, overall EV sales shot up by 153% during FY23, and over 10 lakh EVs were sold in 2022. The scheme had helped pull down the prices of electric two-wheelers by about 35%. So when things were looking up for the scheme and for the sector, allegations of irregularities have surfaced. Government received complaints about misappropriation of subsidies under the FAME 2 by some electric vehicle manufacturers. And after a probe, it recently demanded subsidiary amount of 249 crore from Okinawa Autotech and Hero Electric for violations of phased manufacturing program guidelines. To claim FAME 2 subsidies, 50% of the components in the EVs should be domestically manufactured and resourced. And the companies are also supposed to abide by the price cap set by the government. For electric two-wheelers, it is 1.5 lakhs. For three-wheelers, it is 5 lakhs and rupees 15 lakhs for four-wheelers. But some EV makers allegedly tried to circumvent rules. Probe report said that Okinawa Autotech and Hero Electric vehicles were found to be non-compliant with the regulations through the rampant use of imported parts in place of local parts. But in its reply, Hero Electric reportedly said that its bikes fully comply with the CMVR and FAME certificates. On the other hand, the Association of Companies Making Electric Two-Wheelers, Society of Manufacturers of Electric Vehicles, has claimed that they did not get subsidies for almost half of the 1 million EVs they sold between 2019 to March 2023. As of February 28 of 2023, only 2,835 crore rupees out of the allocated 10,000 crore rupees was spent under the FAME 2. In a petition to the Parliamentary Standing Committee on Industry, Energy and Estimate, Society of Manufacturers have pointed out that the Department of Heavy Industries have done an accounting error, and the department showed that they are close to the target by including the EVs that were not funded under the scheme. The Society of Manufacturers of Electric Vehicles said that over the past 15 months, subsidies worth 1,400 crore had been distributed to the customers out of their own pocket. So, what is behind the standoff and how can it be resolved?
There has been a kind of analysis done by ARAI, right? The government has again issued show cause notice to the companies that are there. And the entire subsidy for all of them has been held up. So it's not reflected in the utilization of the scheme. And therefore, you would see that there is a perception that the scheme has not been utilized. However, should the ministry quickly conclude this issue and disperse the subsidy, then you will see significant kind of utilization of the funds.
So, what is the way forward?
There is a way to resolve this issue. For most of the companies, the amount of the contested claim is only a portion of the amount that is due to them. So the release of the balance claim could be done. You must also take into consideration that during this period, there was supply chain disruptions, there was the COVID challenge. So there has to be a kind of sympathetic consideration of the facts.
The basic aim, as I said earlier, have been achieved. So, but, obviously we may not be able to achieve it fully. So like, for example, in four-wheelers, if you see the set target and, and if you see how many vehicles have actually been, delivered, is way too less. In two-wheelers still, I will say things have gone good. In buses, yes. At least we are we have crossed the half of the target. But in four-wheelers, we are way behind the target. But I think these are the learnings which government really needs to see. And maybe, in next schemes, we will see all these things being addressed.
China has spent close to $60 billion in the last few years to facilitate the EV ecosystem. India too has been picking up pace. The Department of Heavy Industries is in talks with the EV manufacturers to iron out the differences and ensure the compliance of FAME rules. The country and the industry cannot afford to be left behind as the world shifts towards a greener future.
Quick service restaurant companies too, it seems, have hit rough weather. Higher raw material costs and subdued demand patterns have dented their near-term margin prospects. However, with their stock seeing steep correction over the past 6 months, is there more downside in the offing? Or should investors use this decline as a buying opportunity for the long term? Luvisha Darad brings you a detailed report.
Shares of quick service restaurant or QSR players have been under pressure for some time now. Over the past 6 months, related stocks like Devyani International, Jubilant Foodworks, Restaurant Brands Asia and Sapphire Foods have tumbled up to 26% as against about 0.5% rise in the S&P BSE Sensex. So what has led to this deep underperformance in the QSR space? Analysts underline margin pressure emanating from higher raw material prices and weak purchasing power of consumers amid elevated inflation as key concerns.
The key reason for underperformance of the QSR players in the last few quarters, as per our understanding, is first, slowdown in overall SSG growth due to cut down in discretionary spends and weak consumer sentiments on account of high inflation. Second, reduction in the new hiring from the IT and startup companies, where customer from this segment has larger demand for QSR product, has seen the overall slowdown in demand. Third, easing of the COVID-led pent-up demand, where QSR player had seen a strong growth in the last 2 years due to high pent-up demand. So all these factors is resulting into slowdown for the overall SSG growth. And the second reason for underperformance of the QSR player is due to pressure on the margins on account of high raw material prices, particularly in the dairy, where the cheese prices has reached an all-time high, coupled with aggressive store expansion by most QSR players, has added further woofs to the overall performance of the QSR players.
Earlier, in the October to December quarter of FY23, not only did the QSR players see negative to lower single-digit same-store sales growth due to moderation in consumption post-festive season, aggregate EBITDA margins too continued their downgrade trajectory on a year-on-year basis on the back of inflation in agri-commodities and dairy products. Going ahead, analysts expect QSR companies to extend their dismal performance in the January to March quarter of FY23 as well. Here's why.
QSR companies are likely to continue with their poor performance in Q4 as well, while sales growth is expected to be strong at around 20% on a YoY basis, led by aggressive store expansions and a lower base. But lower SSG and continued material cost pressures is likely to keep the EBITDA growth subdued.
That said, analysts expect the financial position to turn around over the medium to long term as inflation ebbs. From an investment perspective, Poddar of Motilal Oswal recommends using this correction to accumulate related stocks for the long term.
We believe that demand might revive from here with the onset of the holiday season and with the inflation stabilizing. Thus, from a long-term perspective, we believe one can use this correction to accumulate these QSR stocks as a long-term opportunity. QSR, with their strong brands, present a great investment case given their low penetration levels in India. We like Devyani International, given KFC's strong brand equity and its growth opportunities, the gradual turnaround that is being witnessed in the Pizza Hut, and along with this, the network expansion across the portfolio and the healthy operating profitability makes us bullish on this company.
Overall, though QSR stocks are expected to witness near-term challenges, analysts expect concerns to gradually fade away in the long term. As regards today, Q4 results, rupee movement, oil prices and global cues will continue to sway market movements.
After restaurants, let us shift our focus to the healthcare sector. Did you know that India still imports most of its high-end medical devices like MRI and CT scanners? And due to their high cost, the prices of health diagnosis and treatment is also high. But that may change soon. The government recently approved the National Medical Devices Policy 2023. But what exactly is it? And how will the country benefit from it? Tariq Ahmed explains in this report.
The COVID-19 pandemic came as a moment of truth for the Indian healthcare infrastructure. Looking beyond just skilled workforce, the government recognized the need for inclusion of policies and action plans on health technologies to meet its public health objectives. The cabinet approval to National Medical Devices Policy 2023 is a step in that direction. The policy aims to enable orderly growth of the medical devices sector in India, thereby increasing domestic production and bringing down imports of medical equipment. Its larger vision is to achieve 10 to 12% of the expanding global market share over the next 25 years. The policy is expected to help the medical devices sector to grow from $11 billion at present to $50 billion by 2030. To that end, the government has initiated implementation of production-linked incentive scheme for medical devices and the setting up of 4 medical devices parks in Himachal Pradesh, Madhya Pradesh, Tamil Nadu and Uttar Pradesh. Till now, a total of 26 projects have been approved under the PLI scheme for medical devices. Of the total committed investment of 1,206 crore rupees, so far an investment of 714 crore rupees has been achieved. The government aims to establish a set of focus areas for growth of the sector in a coordinated manner. In view of the multidisciplinary nature of the sector, the regulations, skilling and trade promotion of medical devices industry are spread over several departments in the government. To achieve the outcomes, the policy has formulated strategies that will cover 6 broad areas of the sunrise sector, including regulatory streamlining, enabling infrastructure and innovation, attracting investments, among others. Encouraging domestic investments and production of medical devices will also fulfill the government's Atmanirbhar Bharat and Make in India programs. Framed with a global outlook, the National Medical Devices Policy 2023 intends to put the medical devices sector on a fast track without missing out on the evolving healthcare needs of patients.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But experts point out that access to funding is a challenge for medical device startups in India. Investors are often reluctant to invest in a sector due to a long gestation period and regulatory uncertainties. That's all for today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.